Joining us for an extra special afternoon hit, Ann Sonders, the one and only Chief Investment Strategist from the New York Stock Exchange. Ann, good afternoon. Great to see you.
Hi, Oliver. Good to see you, too.
So I guess after 15 years of ETFs, we learned that people love them, right?
People love them. And, you know, what's interesting about the ETF space is the growth rate and the dominance on the active side of things. And I think that's part and parcel with some of what's going on in the market of maybe a shift toward fundamentals and prices reconnecting and a more level playing field for active relative to passive. So that component of the world of ETFs is exciting too.
Love that. We saw some really interesting data on kind of what people expect and why they're using ETFs. It seems like they're pretty committed and they're ready to keep diversifying how they use ETFs. Let's talk about the session today, though. Let's talk about the data this morning and the week here, Ann, as it seems like the main event is us pricing down some of the dovish expectations, pricing out some of those deep cuts. What do you make of that?
Well, certainly the notion of 50 basis point has been tossed aside for now. And of course, we've got additional inflation data and another jobs report between now and the November FOMC meeting. But even as of this morning, you've had about a 20% probability that the Fed would not do anything. And that's just based on the data we have at hand. You know, today's data was hotter, slightly hotter anyway, in terms of the CPI print, and also higher in terms of the claims data. Now, it appears that the Fed's reaction function right now is geared a bit more to the labor market side of things. But my guess is if we were to get a continuation of an uptick in the inflation data, that's not necessarily our base case, but I think something to consider, then I think you might see the Fed reaction function not shift back toward inflation, but maybe be equally divided among their dual mandate.
The stepwise process, will we be paving new ground here, carving out kind of a new trajectory compared to history, Ann? Do you think this kind of reflects a unique period we're in, the stop, the go, the fact that maybe they can hold off before doing another cut?
Yeah, so there is precedent for the Fed coming out aggressively out of the blocks, but then stopping. That's actually what happened in 1967. Now, the background conditions are not necessarily the same, but it's not unprecedented for the Fed to do that. The bias is still that the Fed will stay in easing mode. Again, at this point, it certainly looks more like 25 basis points if they move in November, but there's nothing to suggest that they couldn't sort of do the pause that refreshes to assess incoming data and then, re-exert the easing cycle. But I just think it's premature to know what they're going to do at the November meeting, because obviously we do have a lot of data between now and then on both sides of their dual mandate.
As far as the trajectory for inflation goes, its connection to interest rates, as we talked earlier this week, rates going up for the right reasons versus the wrong. I mean, one inflation print a little bit off expectations, we can still say rates are going up for the right reason?
Yeah, so I think, moves in say, the 10-year, which is most correlated to what the equity market does, and we have switched the correlation between yields and equities from negative back into positive territory, notwithstanding, I think, the maybe some indigestion that came with the 10-year jumping above 4%. I think that helps to explain some of the volatility and the underlying weakness that we've seen in the market. But in general, a backdrop where yields are moving based on the growth trajectory and not based on the inflation trajectory is probably a decent backdrop for the equity market. Were that to shift back, where yield moves were more closely tied to inflation moves, then I think you could revert back to that negative correlation. Notwithstanding, I think, again, some of that indigestion where you just get to even that psychological level of yields jumping above 4%.
Like that. All right, the other big thing tomorrow, earnings. Give us a quick thought, Ann, as we kick off this season. What's your main thing you're looking for?
Well, it looks like, given how much analysts cut estimates, particularly during second quarter reporting season, when you started second quarter reporting season, estimates for third quarter were about twice as high as where they are right now. But what that might mean is that, yet again, analysts set the bar a little bit low, and you'll end up going throughout the season with a better than average beat rate, percent by which companies beat. But I think an important theme to think about is that analysts lowered estimates for the third quarter, again, cut them in half, but really didn't touch fourth quarter estimates or into 2025. I'm not sure that that sort of V bottom and then a reacceleration is reflective of reality. It's just that analysts are getting information from companies with a shorter time span. So they're making adjustments maybe a quarter out, not making many adjustments. If we were to see 2025's estimates come to fruition, of course, that's embedded in forward valuation numbers, it would mean that profit margins are at an all-time record high. That may be a little bit of a stretch. So we'll have to see, even if companies beat that lowered bar, what the trajectory is for estimates in the fourth quarter. See whether that trend persists, where analysts wait until, in this case, third quarter earnings season before they make informed adjustments to fourth quarter.
Okay. It sounds like we've got a little bit of pressure to justify the market, but not unreasonable. As we're kind of talking about with Nate, we're expensive, but at least it's not like manic like COVID days. So hopefully we just don't get disappointments. Thanks for your time, Lizanne.
Good to see you.
Appreciate it very much. Likewise, Ann Sonders, Chief Investment Strategist at Charles Schwab.